Oh, it's, it's great to be back in the Bahamas. I love it here. I got to bring the kid. I told Tony I got to bring the kids back next time. But thanks so much. It's a pleasure to be here. CFAL, Tony and the team, magnificent job on this conference. Um, how many people remember the great financial crisis? Anybody? It was a long time ago. It was 16, 17 years ago. I was a trader at Lehman Brothers, and that's really what brought upon this book. This is my second book, but I was a trader there, and I tell my wife Annabella once a month, if we sell 1 million books, we'll break even on our Lehman stock. And the book's now in 12 languages. We've done about 140 speeches around the world. And the best part is the people that you meet around the world, the mentors. The mentors are key. And that's what this book is all about. I was able to sit down with Charlie Munger, David Tepper, David Einhorn, and we run a Bloomberg chat in New York and in Florida with a lot of really wonderful pension fund managers, hedge fund managers. And what I'm going to do today is share some of that intelligence gathering from it's like a live ideas dinner where we're sharing that information. And I think the key is going around the world and meeting great people. Been to London 10 times, Toronto 5 or 6 times, and each time I met a really good mentor that's what I call on the buy side, a CIO level person. And when you crowdsource information every single day, you can really gather intelligence in a right way and help people. And that's what this book is all about. And I'm so grateful to CFAL and to Tony. And Tony is, when the Lehman book came out I think in 2009, I've started meeting so many interesting people. Tony Ferguson was one of the most interesting people in the sense that he's got a burning desire to take his game to the next level every day. And the Bahamas is blessed to have him. And in meeting people around the world, in meeting people around the world, I mean, that really motivates me when I meet someone that's close with the government, close with the pension system, and they invest in themselves. They really raise the bar every day for higher learning, and that really inspires me. So let's kick it off. The old party's over here. Not quite. We're still partying on in Washington for sure. But this presentation really, I'm going to go behind the scenes to what's really happening, not just crypto, but hard assets. How to listen when markets speak. Our book theme is financial assets are really just paper certificates, bonds, right? And if you think of the planet Earth right now, every investor in French bonds since 2022 is losing money. UK bonds, every investor in UK long-term duration bonds is losing money since 2022. Same thing in the United States, same thing in Japan. And so what's happening is each day, each week, each month, that investors have lost money in what we call paper certificates now. These are promissory notes from governments. That's driving capital toward hard assets. So there's a chapter in the book about gold, platinum, palladium. And at the end of the day, people forget from 1968 to 81, by the time you got to that 1981, almost 50% of the S&P 500's composition was materials, energy, oil and gas, and industrials. 49, 50%. Think about that. And that's what's happening now. In recent years, in that deflationary cycle, we got down to only 11% of the S&P 500 that's really in hard assets. It's just amazing. And so now we're really, in the last year, we're really moving capital. We're seeing a great migration of capital back toward hard assets. The distant dream getting more distant. AI. So right now in the United States of America, there's a chapter in the book called The Dark Side of Passive Investing. And Jack Bogle is a famous, really founder of indexes. And when they created the S&P 500, they wanted Jack Bogle, if you talk to him and I've done a lot of research on this, talk to his people that worked with him for years, they only wanted the top 2 stocks in the S&P 500 really should be 5 or 6% of the S&P 500, maybe 7. Today, the top 2 stocks in the S&P 500 index are 14, 15% of the index. 2 stocks, Microsoft and NVIDIA. So if you have $1 million in the S&P, people think that's a safe investment. It's an index fund. It always goes up. But you're much more concentrated than ever. 15%. So $1 million in the S&P, 150,000 is in that concentration, 2 stocks. And 2 stocks that are trading at 30 times sales and 14 times sales. So what I'm seeing financial advisors do right now in the United States is, I think we have a lot of great ones in our Bloomberg chat, in our Bear Traps report, but I'm seeing them actually reconstruct the S&P 500 so it's less concentrated for clients. And to me, I think that's a really good fiduciary. Now, data centers, artificial intelligence. The biggest trade upon us the next 10 years is not in NVIDIA and Microsoft. It's in the power systems and the infrastructure. The US power grid right now, the US power grid is 50 years old in some places, 30 years old in others. So think of that. The US power grid is like a 90-year-old man, and we're going to put all the data centers on this 90-year-old man. How many people have ever been to Berkshire Hathaway's annual meeting? Charlie Munger was a mentor of mine, and I was very blessed. So you walk into Omaha, and you fly in, and you start going to the parties on the Friday night. And on Saturday, you go into the Quest Center, and there's 30,000 people in the Quest Center asking Mr. Buffett and Mr. Munger questions. And Charlie just passed away, God bless him. But Charlie had invited me to Omaha, and he'd read my first book. The funny thing is he absolutely hated Dick Fuld, the president of Lehman Brothers. And so I brought my wife, and we were sitting there in the conference, and the Q&A goes on for about 45 minutes. And I lean over to this lady next to me, and I said, how long does this Q&A go on for? And she goes, about 5 or 6 hours. And I'm looking at my wife, Annabella, and I'm getting the death stare, absolute death. And so she says, I'm really in the mood for lunch. And I said, well, what would you like for lunch? And she said, how about some sushi? Because we lived in New York. And I said, honey, we're in Omaha, Nebraska. There's no sushi in Omaha. So the next day, we end up in the Marriott Hotel. And I walk through the foyer, and there's Mr. Buffett with some pension fund people. And then I look around the corner, there's Bill Gates with the Sovereign Wealth Fund. And I go to this room, and my wife and I are waiting for Mr. Munger. And I said to Annabella, my wife, I said, when Charlie comes in, just say hi and goodbye, because I only have about 25, 30 minutes with one of the greatest investors of all time. And so Charlie comes in, he grabs my wife by the arm. And this is like maybe a couple of years after Lehman Brothers. He grabs her by the arm and he says, young lady, I just want you to know before you leave, hardship is good for you. And I said, Mr. Munger, you're one of the richest men on earth. What do you know about hardship? He said, Larry, 1952, I had 40 lawyers in my law firm in Los Angeles. And on a Wednesday afternoon, 30 of them walked out the front door and they quit. He said he woke up in the middle of the night, 3 in the morning, leaned over to his wife and he said, honey, if I lost everything, would you still love me? And she said, I'd love you, but I sure would miss you. And Charlie is just, he's giving the zingers, you know. He's such a funny guy. But you know what he said and we talk about this in the book. He said, Larry, testosterone is a young man's kryptonite when it comes to investing. And think about what he's saying. That testosterone, everyone has to be invested. Everyone's watching CNBC doing the next trade. And he said, Larry, all the money is in the waiting. And it's such a great line. And I think that's the key today, too, because we're seeing all this money flow into artificial intelligence. and all the money is chasing different cryptos, but all the money's in the waiting. He said the toughest thing to do is stare at a screen all day and do nothing, and just do research and wait for those wonderful opportunities that come. And if you think about the last couple of years, we've had a couple of April 8th was a great day to buy stocks. I don't know if mid-October is, but robotics once again. So if you do the math, the US power grid has to be rebuilt for the data centers. And then if you think about Elon Musk talking about 100 million robots, and if you just do the math, the copper required to rebuild the Ukraine, rebuild Los Angeles, for 100 million robots, think of the copper. Think of the copper to support the data centers. No one's doing the math. One of the most incredible copper mines in the world, the most productive, was shut down in Panama in recent years. The political dynamics in the world on copper are daunting. We are heading for a OPEC-style crisis on copper at sometime in the next 2 years, because what we're doing is we're suppressing the supply politically. Nobody wants the copper produced in their countries. This copper mine in Panama was literally one of the most productive on the planet Earth, because you can get the copper out the Pacific Ocean in 5 minutes. And same thing in Chile and Peru. If you look at the big copper mines globally, the last 10 years, 20 years, and remember, it takes about 7 to 10 years to get one of these things up and running, right? The copper production in terms of new mines coming on is just, this is going to be like turning an aircraft carrier around in the middle of the Pacific. It's going to take a long time. And that's why, at the end of the day, copper prices will double, triple from here, because as copper prices go up, that will break the back of the political resistance to copper mines, to new copper mines. Okay, so inflation and interest rates. This is fascinating. I mean, you think about the economy seems strong. The stock market's at all-time highs. But if you notice here on the far left, in the 80s, when we were in that high interest rate, high inflation regime, consumer confidence was low because families can't make ends meet with that inflation and higher interest rates really attacking the American family. And so right now we're essentially at Lehman levels, and we're right on the 1980s levels. That's all inflation, that's all interest rates. And as the Fed is cutting rates, and the White House wants to cut rates a lot more, that weakens your dollar, and that probably gets you a deeper inflation problem. So the White House is at really panicking right now, because literally to get into an American home today, because of the prices of homes, it's literally the highest level of home inequality just about in the history of the country. So the White House wants to try to lower rates on the front end to try to support the housing market, because the midterms, I was in the US Treasury 2 weeks ago. I was in the Treasury, met with a good friend of ours there, and he said, Larry, the midterms are 1 year away, about 13 months away, and we have to get rates lower to support home ownership. And with interest rates high and inflation high and home affordability at record lows, that is a real problem for Mr. Trump in the midterms. And we were talking last night, Chicago and I, about the midterms. It's really important that if Trump loses the midterms, then the entire agenda shifts, right? And Obama lost the midterms in 2010. Trump lost the midterms in 2018. Trump lost the midterms. And so when you lose the midterms, you lose control of the House, you lose control of the Senate potentially, and that really stops your agenda. India. There's 1 billion people in India that don't have air conditioning. There's 1 billion people in India that don't have air conditioning. What we've done in the United States is we've taken 5 million jobs out of the United States. We've pushed them around the world. We've raised the standard of living dramatically. If you're in India and you work in a call center in India, and you're 25 years old, you're making about 10 times more than your great-great-grandparents. What's the first thing someone in India does when they're making 10 times more than their great-grandparents? They go out and buy a moped. They go buy a car. So we're raising the standard of living, but we're creating a whole bunch of new carbon consumers. So we're coming into a period where financial assets and stocks are really moving toward hard assets and commodities. Just take silver, for example. Silver today is less than 1% of household wealth assets. In the 80s, you're talking up near 3%. So we're coming to a period where investors are going to own more and more commodities the next 10 years because of this new regime that we're in with higher rates and inflation. And this is where we get into, we were talking about last night, Shivago, about inequality driven by artificial intelligence. So you're just talking about artificial intelligence driving up electricity prices in the United States. And so think about this, the concentration of wealth in the S&P 500 that's in 2 stocks. Now, the growth projections of NVIDIA and Microsoft depend on those data centers being constructed and then opened up because all those chips in the data centers. But the problem is, because of the political pushback across the United States, because of higher, you can't just put these data centers anywhere because the utility in that region, you're going to push up electricity prices for everyone in that region. And that's why what we're seeing right now, on our institutional investors in our Bloomberg chat, we're seeing more and more investments in not just nuclear, but power sources that are on site near the data centers. So the data centers will be forced politically to have their own power sources. And Tony's doing amazing things in LNG for this region as well. But at the end of the day, the utilities of the United States politically are getting more and more political pressure here from higher prices. And this is what we talked about the Rust Belt, 5 million jobs, we've taken them out of the United States, but now we're going to reshore jobs. So Trump and Mr. Biden too, they wanted to bring jobs back to the United States. 10 years ago, 15 years ago, President Obama said those jobs are not coming back, right? And that just shows you what's happening in the United States. Both Republicans and Democrats 10 years ago, 15 years ago, they were pounding the table. Those jobs are not coming back. It doesn't matter. But now populism in the United States, driven by Trump and the election of, just look at populism in the UK. The Reform Party is now like 2 standard deviations higher than every party. That's your populist in Nigel Farage. So we're seeing these populists around the world because of this, because we've decimated the Rust Belt through globalization. We meant well. We got cheaper underwear from a Walmart, right, which is nice. But we exported a lot of jobs to China, but we really created a political tidal wave toward populists. And that's where we get into protectionism and reshoring. Now think about reshoring. Now we're going to reshore jobs back to the United States. The cost of labor, that basically takes inflation and sustains it near 3%. And the difference between 2% and 3% inflation on a sustained basis over 10 years is just mind-blowing. If you look back over the last 500, 600, 700 years, 1,000 years, civilizations can really be destroyed by higher levels of inflation over time because it just eats away at the consumer and the consumer standards of living. And that's why we're seeing this stampede of capital out of financial assets, paper certificates, indexes, into more hard assets for the first time. And it's a prediction in the book, and I owe it so much to the great mentors that we have here. As young people, always go out, ask first of all, pick 3 mentors. Tony's a good one, but try to take them out to lunch and ask them lots of questions, right? And then that's what I did through my career, is I kept building great mentors and getting that ecosystem of intelligence gathering to try to really help people understand what's going on, behind the scenes in New York and Wall Street. So, the rush to hard assets. Now, there's really two stories here. One is this has been such an extreme move into hard assets. Caterpillar's now becoming a data center play. So think about since 2008 to now, Caterpillar's never been 62% above its 200-day moving average. And it is today because of this everybody wants into artificial intelligence. So you got to be very careful of things like that. And if you look back, it's very, very rare. You can see there, it's never happened before. Same thing, your metals and mining ETF. Now your metals and mining ETF is now at its highest percentage above its 200-day, 60% above its 200-day moving average. That's never happened before. So I think what's happening is we're at the beginning of a new bull market in hard assets. And that first stage is very dangerous because the tourists, how many people have seen the heavy-set guy getting off the bus, the Hawaiian shirt and the camera? The tourists are all coming in, right? And so it's a new bull market. It's in the early innings. There's a lot of hot money tourists that are, for the first time, actually investing in metals. And that's dangerous, but you're in the beginning of a 10-year bull market, so you can buy the dips, but you got to be very careful right here because the hot money is really coming. A lot of tourists are getting off the bus. As you can see here, 60% above the 200-day, just remarkable. And this is your capital expenditures for data centers. And you can see here, I was in Silicon Valley a month ago, and we're sitting down for dinner, and this chief investment officer said, "Larry, this is a Dr. Oppenheimer arms race." He said, Zuckerberg from Meta, Larry Ellison at Oracle, they don't care. They're all in. And so companies that were cash cows the last 20 years, Oracle, Meta, Microsoft, these are cash cows. They're now becoming extremely capital intensive businesses. And these are the types of things that Doug's looking at, crowded trades. And you've gone from cash cows for 20 years to becoming the most capital intensive business. All that means is they're investing a huge portion of their market capitalization or their free cash flow into artificial intelligence. And it's like a Dr. Oppenheimer arms race for the nuclear bomb. It's the same thing. They're just terrified of being out, everyone wants to be first to get the bomb, right? And here, everyone wants to be first to get the highest, most perfect level of artificial intelligence. And by the way, this ties back into passive investing. So if the top stocks in the S&P, which have been real big money makers for 10, 20 years, all of a sudden, they're now capital intensive businesses. It reminds me of Global Crossing, Cisco in 2000, where you have a just change and really overinvest. Think about Global Crossing. The theory was you had to build out all these cables around the United States to support the internet. And there was a massive overinvestment. And the smart money that we talk to says that same thing is happening now because it's a Dr. Oppenheimer arms race. And something fascinating is going on here. So the metals versus the Qs, most overbought, at least in 10, probably 20 years. So once again, the tourists are getting off the bus. There's a lot of hot money coming into metals, and you can see there the QQQs. Big tech getting really destroyed. Big tech's being destroyed by metals the last 5 years, even back to 2015. Now, here's my best idea for the fourth quarter, and here's what I'm seeing is that it's just like 2000. A lot of money went into tech, and healthcare has been really hammered. It's the worst sector in the S&P, and there's a lot of tax loss selling in the healthcare space. So healthcare is the cheapest to the Nasdaq, probably in our lifetimes. and you're going to have a big rotation back into healthcare next year. So remember, you get that tax loss selling in October, November, typically peaks. Americans want to take the tax loss because there's a lot of gains in the market, right? So your accountant's calling you right now in America. They're saying, hey, listen, Fred, I need a loss. So investors are running to find these losses. They're going to sell the healthcare stocks in the fourth quarter. And then because of there's so much capital, right now there's 28 trillion in the NASDAQ 100. 28 trillion in the NASDAQ 100. In 2021, there's only 12 trillion in the NASDAQ 100. So 2020, late 21, fourth quarter of 21, there was $12 trillion in the NASDAQ 100. Now there's 28. And so that money is rotating into small caps. You're going to see it rotate in healthcare in the first quarter. Now, as you can see here, even though tech's having a good year, gold's destroying tech. And once again, financial assets to hard. So all this shows is gold, those moving down, that's gold outperforming technology. And here's another way to look at it. I mean, this is Peter Lynch in One Up on Wall Street, and I've had lunch with him before. He's come to some of our Friday lunches from time to time, but he says, the stock I want to stay away from the most is the hottest stock in the hottest sector, right? So Apple was the hottest stock in the hottest sector, and now Apple's basically unchanged since December, with gold up 55, 60%, silver up 75, 80%. So once again, financial assets, paper certificates, over toward hard assets, early innings, but really crazy overdone here. Look at it, I mean, Amazon, talk about this, the hottest stock in the hottest sector. Amazon was the hottest stock in 2021. Now you can see here, gold dramatically outperforming Amazon. So capital is moving from financial assets over toward hard assets. And the good news is there's such little capital in hard assets that it doesn't take much to double or triple prices, which I'll get into. Now, here's something interesting. Everyone knows now, we hit these emerging market countries over the head with sanctions for like the last 10 years, right? 20 years, both Republicans and Democrats. Sanctions, sanctions, sanctions. Obama, Trump, they all use sanctions, Biden. And what's happened is, after the war in the Ukraine, we've taken $300 billion has been confiscated essentially from Russia. And so you've got a lot of governments around the world that have been rushed into gold, but they haven't really rushed into silver. And so you can see here, that gold-silver ratio in our typical commodity bull market should be down in the 30s, 40s, 50s, but we're still near 80. So this speaks to a potential phenomenal opportunity in the silver space over the next couple of years. Silver's overbought today, once again, but in a real commodity hard asset bull market, silver should dramatically outperform gold looking forward, because there's a lot of central banks that are afraid of policies from the US. Those sanctions, that confiscation of capital, those sanctions, that's forced a lot of money into gold and the hard assets. If you're a central bank around the world, you want to own, you're too exposed to dollars, you want to own gold. And that's what's happened here. That's what's creating this cheapness of silver relative to gold. And here's your platinum, palladium. And this is palladium. Tony and I, we've been buying, in our trade alerts, we've been buying platinum and palladium in last year and early this year. As you can see there's a big move in platinum. Remember, all the gold ever mined in the history of humanity, everyone's heard this stat, would fit in an Olympic-sized swimming pool. How many people in the room have heard that one? All the gold ever mined would fit into an Olympic-sized swimming pool. All the platinum and palladium in the world ever mined would only go up to your ankles in that same pool. Think about that. That speaks to these hard assets that just aren't owned by anyone. And that's why you're seeing this kind of price action. You see here, that's the palladium first, now here's platinum. Platinum, palladium, the new green hydrogen is going to need a lot of platinum and palladium. Platinum and palladium could be a real big green metal over the next 20 years. And remember, there's only about $350 billion of platinum and palladium in the world, 350 billion. Crypto, just in Bitcoin alone, I think you're near 2 trillion, right? So, and gold has now gold's $24 trillion, 23. So gold's at 23. Crypto, Bitcoin I think by itself is around 2 trillion. Platinum and palladium around 370 billion. Nobody owns it. And so it doesn't take much when you move from financial assets to hard assets to get the kind of violent price action there. Now, what's a very important thing, and Doug, I think you'll appreciate this. When tertiary, I was in San Francisco a couple weeks ago. I sat down with one of our clients. He runs Larry Ellison's Oracle Family Money. And he said one of the things that they've been focused on in Silicon Valley is tracking and measuring tertiary assets versus established. And all he meant was that Bitcoin, if you look at Bitcoin of late, relative to, say, the S&P or the Qs, Bitcoin's down like 12% the last 2 weeks. And the market's still at all-time highs. So what we're starting to see is a lot of the hot money stocks or trades. We had the biggest loss in crypto on Friday, I think almost ever. It was one of the largest losses. Over $10 billion was lost in like a half an hour. Because there's a lot of leverage. These kids are buying crypto on these phones with, like it's an NFL game. It's absolutely, the leverage in crypto is nuts. And that kind of leverage creates these big drawdowns. So as you can see here, you want to buy Bitcoin and sell your gold when that ratio gets into that 15 to 25 range. We're not quite there yet. But in the last 5 years, whenever that ratio got down into the teens, 20s, if you sold gold and bought some Bitcoin, you did much better. And I find it fascinating that we bounced off of that 35 ratio 4 or 5 times now since 2021. So this is really important that you track the gold, and you can do it by hand, you can do it on a calculator, the gold to Bitcoin ratio. And as you can see here, once again, the equal weight S&P is essentially unchanged. That's just your S&P right now the S&P 500 is market weighted. So that means the big stocks are a bigger part of the index, This is the equal, and you can see there hard assets destroying financial assets. The fiscal and monetary response to Lehman Brothers, once again, was $4 trillion to the financial crisis. The fiscal and monetary response to COVID and the regional bank crisis since 2023 has been $16 trillion. So that kind of monetary debasement and this global insecurity around the dollar has created this big move in the dollar versus the stocks. And here's something really important for everyone to understand. Software is in a lot of pain now. Adobe's down 50%. And what's happening is the smart money's telling us that this $2 trillion of capital investments that are coming into data centers and artificial intelligence, is really going to come after software. And as you can see here, software stocks are down 3% this year in a raging bull market. And that's because artificial intelligence and data centers and all those investments at $2 trillion is going to create a lot of victims in software. And as you can see here, staples versus discretionary, all this is telling you here is that the staples are your recession-proof stocks. You know, your Colgate Palmolive, you know, your soaps, your dishwashing detergent, your Hershey's chocolate. Your staples are starting to outperform discretionary now. So this is really important because if we're coming into an economic slowdown, you should see that staples outperforming. You get that bounce there on the far right. To me, that's important. You want to watch this very carefully. You want to watch staples because if staples are outperforming, that's a sign that investors are a little bit worried about the economy. I'll just end it with this. I'll close. The banks in the United States. So Buffett has sold Warren Buffett in the last year has sold 400 million shares of Bank of America. And Jamie Dimon has sold 32% of his JP Morgan stock. So Mr. Buffett and Jamie Dimon, probably the two best investors, probably two of the best in the world, are dramatically taking down their exposure to the banks. So I would just say here, This is a really important thing. Right now, the banks are trading at the highest percentage of book. So you want to be taking down your exposure to financials along with Buffett and Jamie. But I think we can open it up to questions. But
question on gold and silver going up, and then the potentials in the future for regular investors. Why should we hold gold or silver? I mean, what's the purpose of holding it?
Well, what happens is as governments, when governments become reckless around spending, the amount of bonds that they have to sell goes up and up and up. So if you look at treasury bonds, the auction sizes in US treasury bonds are up like 500–600% the last decade. So the amount of bonds the United States has to sell, the amount of bonds France has to sell, the amount of bonds that the UK has to sell to fund all that spending is it has exploded higher. And when a lot of wealth in the world is in those bonds, what we call financial assets, they're just paper certificates. When that happens at a very aggressive level, which is happening, then people want to own things in the ground, right? They want to own gold, silver, not just gold and silver, but copper, anything in the ground, because what happens is if you go into a new inflation regime, historically, if you go into that higher level of inflation, higher interest rates, those metals will typically give you some protection against what we call currency debasement. And remember, the only way out of a $38 trillion debt hole is to inflate your way out, right? And that's what I think people are suspect that the government's up to. Next one.
Thanks. What are your thoughts on investors' flight from the US dollar into other currencies and safe havens like gold?
Right. So what happened was when they really started the trade war. Once again, this goes back to populism. So because we exported all those jobs out of the United States, 5 million jobs, we decimated the Rust Belt. Trump's trying to use these tariffs to bully club jobs back to the United States. Whether or not that's effective or not is still yet to be known. But when you do that, and you're aggressive with that billy club of tariffs, and you've been aggressive with that billy club of sanctions, both Republicans and Democrats, I've been at dinners with pension fund managers in Europe in the last 6 months where they're like, I'm being ordered. So let's just say you're a big allocator in London or in Germany or any part of Europe, Zurich, and you're a big allocator. Those allocators are being forced, like with a gun, to take down dollar exposure because the United States has been not as friendly, and the uncertainty level coming from tariffs and deficits are creating some unease, and that's why the dollar's made this big move down. It's bounced the last couple of weeks. It was oversold, but if they cut rates aggressively, the dollar's really going to get hammered, and that's going to create a whole new uptrade for this hard asset trade, commodity trade.
I've had these conversations with the top investors like Charles Munger and all. I just want to know them, with your interactions, how they are feeling about the sustainability reporting and ESG reporting. Sustainability reporting, ESG reporting, are they really considered about those buzzwords, or else are they just compliance-related buzzword? I just want to know what's their sentiment on that.
We talked about this last night, Shivago and I, and Tony. In 2020-21, we were talking about the Green New Deal. Every Bloomberg terminal in the world had an ESG mandate portfolio. So all these allocators were being forced into ESG. Like, it was just insane. You couldn't own a coal stock. The coal ETF, the KOL, went out of business, right? So ESG was like the buy-in to ESG which is a form of investing in companies that are supposedly ESG friendly. And that got so overdosed that now we're in literally today, you think about rare earth metals, right? And enriching them in the United States, there's nothing dirtier than that. And so we've gone from an extreme belief in ESG to now, like I said, the XME metals ETF, which includes a lot of speculative metals. This is dirty business. That's now the highest percentage above the 200-day. So we've gone from like one world to a totally different world. And it probably goes back toward ESG after they, break some rules. And they're really, the environmentalists were extremely powerful in 2021, and now they're extremely weak. And so we've gone from one extreme to the other.
Question?
But I do have a question.
One more
Oh,
question.
you have another question? Super.
One more question. Awesome. How would you recommend to retail investors, the percentage-wise in terms of diversifying their portfolio over the next 10 years?
I'm sorry, I just could.
How would you recommend to retail investors to diversify their portfolio over the next 10 years, percentage-wise?
Well, most importantly, over the next year and a half, the ratio of gold to oil, and this is probably the most important part of the presentation, is at those COVID levels. And oil and gas equities like the FCG ETF is a basket of natural gas stocks. The artificial intelligence boom with the data centers is going to require, I think natural gas prices are going to be up 300% the next 5 years. And that means companies that control natural gas assets are going to be up a lot. And so right now, everyone's invested in NVIDIA, $4.6 trillion in NVIDIA, $4.6 trillion. The three biggest stocks in the FCG ETF, which is the natural gas equities, are only worth $250 billion, the three or four biggest ones. So everyone's over here in the chips, and no one's over here in the power for the chips. So for younger people, right now, it's the perfect moment to really dig in and understand natural gas. And look at Buffett. He's selling his Apple, and he's buying Occidental Petroleum. So Buffett's selling technology. He sold like billions and billions of dollars of Apple, and he moved billions into Occidental Petroleum, which is oil and gas. So that's probably the best idea that you can take looking forward.
Larry, is what's happening in the stock market mirroring what's happening on the ground in terms of real world investment? Or we seeing one of those kind of herd mentalities, over exuberance kind of thing that might give rise to a bubble?
Right. It's almost like The Tale of Two Cities, the book. It was the best of times. It was the worst of times. It was the age of horror and the age of abundance. So the person on the ground is so nervous about their jobs, nervous about inflation, nervous about artificial intelligence taking their jobs away, versus the market is, my good friend Andrew Ross Sorkin has what's fascinating is, this is really, I think, I'm glad you asked this question, because Andrew Ross Sorkin is a friend of mine. He's on Squawk Box. I wrote A Colossal Failure of Common Sense in 2008, and I beat him by about 4 months, 5 months. I got my book out first, and we joke around about it. He's been kind of mad at me. He said, Larry, you beat me. Because it was the key to getting those books out during the financial crisis is that first mover advantage. And so I beat him. His book was Too Big to Fail. That was the famous book. And he sold a lot more copies than I did because he's on CNBC every day. I talked to Andrew the other day. His new book is coming out. It's called 1929. And it's fascinating because he's kind of talking about what you're talking about. It's that inequality where it's the best of times, there's a lot of speculation, but the average person is just not doing that great. And I told Andrew, I got the book out last year, I beat him again. So, but he's a very successful young man, and he's a brilliant writer. And But thank you so much. I mean, this has been incredible. I really, Tony, thank you, my friend.
Thank you. Thank you, Larry. Good to see you.